Hey everybody, what's going on? It's Rupert here. Just recently, there was an office building in DC that sold for $72 million in 2018. Now that sold for $16 million. And imagine this, another building in Chicago that sold for $61 million in 2012, now sold for, guess what? $4 million. Something's not right. Property values, they don't go down like that in such magnitude. And you're in luck. We're going to explore what's wrong. We're going to find out what's really the problem, what's causing the prices to go down. So again, we're going to talk about what's wrong with the commercial real estate market in America and why it is turning into the greatest real estate crisis in decades. How does this affect consumer sentiment? And most importantly, how does this affect you right at home? So guys, do me a favor and like, subscribe, and let's get into the video. So let's get more in detail with what's really happening in the real world. $929 billion of commercial real estate is set to mature in 2024 this year. That's a massive amount of debt that's coming over this year, and that really with the higher interest rates is one, affecting the consumer sentiment, two, affecting businesses to run properly, and it just works in a domino effect, affecting every other industry around it. It's not good for commercial real estate. And if you thought that the owners of these real estate buildings are the only ones in trouble, think again, because those banks who are regional and local banks that provide loans to these real estate buildings, they're the ones that are actually in trouble. I'm talking about the companies that have around 70% of their real estate portfolio in commercial real estate. So they provide loans to commercial buildings. And with the higher rates, they're seeing the value of their assets drop. As I mentioned, the two properties in the beginning of the video. And worst of all, there's a chance that they might not even get paid. Overall, it's really not a good spot to be in as a bank, given that last year there was the biggest bank failure in terms of assets. Obviously, with Silicon Valley and Signature Bank, it's not a good spot to be in this 2024. Now let's go to the next topic, and I already touched on it a little, is the higher interest rates. Since the Federal Reserve started raising rates in March 2022, the commercial property prices have dropped by 11%. Higher borrowing costs make investments in commercial real estate more expensive, and they also slow down the economic activity, which reduces the demands for these properties. Again, with the higher interest rates, it's not something that helps. Perhaps with lower interest rates, there would be something that would be manageable and companies wouldn't be panicking like they are now. But higher interest rates are really causing big pain with everybody involved. And for context, during past rate hikes, we did not see such a steep decline, and that's because of the sheer pace and the sheer scale of the rate increases that we've seen done by the Fed. It's just that the interest rates were increased to such high levels in such low time that the market didn't have time to react. Now it's getting time to react, and now it's adjusting, and obviously we're seeing the impacts of those adjustments. This is not pretty. Now, going away from interest rates and the property values, let's go into office vacancies, because that's also a big part of the commercial real estate problems that we're seeing. Office vacancies is something that most people don't talk about or they just don't know about. So let's go into that more. So obviously there was a mentality shift that happened during COVID. Everyone thought that, hey, I should go to work. That's what I should do. And that's what is necessary to, to get things done. But now it's completely opposite. Now they have another option. Now they can stay at home. Now they don't need to go to work. So if you notice, I want you to go drive by if you have time, like go and check how many parking lots are full. There are not going to be that many that are full in the middle of the day during a weekday. It's not going to be full. And I can relate this from my own job because I also work an office job. So my job that I work full time and as I speak right now is hybrid, which means I work 4 days at home and 1 day in office. And before you call me a hypocrite about, hey, you tell everyone to go to work, but you actually stay at home, I didn't go out looking for specifically a work from home job. It was just something that was offered to me. And that's the way this company runs things. So be it. But what I can tell you from my own experience when I go into office, so 1 day out of the week, and I love going to office, is that 75 to 80% of the people are just not there. So most of the equipment that we have in office is really just unused and it's collecting dust for so long. I see the same thing every day happen. So what does that mean for the company? Well, if you look at it from the company's perspective, they're actually losing so much money in that. They're paying the lease to the owner of the person who owns the building, which is obviously, I'm assuming, is a lot. They also pay the security, they pay the janitor, they pay electricity, the water, the heating. They pay all those bills for only 25% of the people to show up. That doesn't sound like a good investment to me. So there's two types of solutions to this, and there's two companies. The first company is deciding to just stay at home. You know what? Just work from home, forget about coming in office. We're not going to renew the lease with the owners of the building, and just work from home. Forget about coming in office, forget about meeting people and It's all from home. The second type of company, like Elon Musk, I think he's heavily against working from home. But the second type of company is asking everyone to come to office, and they're almost eliminating completely working from home. But you know what? Hopefully it is true. But if I'm ever the owner of those companies, I would actually have everyone come over and work from office, because not only does it build connection, not only do you get better at work and you are more efficient, it's better for the company. The resources that they spend so much money on are actually being used. So there is actually value to their investment. Now let's bring it back and talk about how does this affect you? And as a person, maybe you're not invested in real estate. Maybe you don't have any investments, or you're not connected in any way, but it does affect you because the effects of this are very, very wide reaching. Take cities like New York and San Francisco, for example. They rely heavily on property taxes from commercial real estate to fund public services. In New York City, commercial properties contribute about 16% of the city's total tax revenue. With property values falling and vacancy rates rising, there's less tax revenue, which could mean cuts to public service or higher taxes for residents. Plus, lower property values and higher vacancies, obviously they're going to lead to fewer retail sales and less use of public transport, which further hurts the local economy, and very much it's connected. On a broader scale though, like something that you guys may not know is this also affects retirement savings plans. Here's how. So there's a lot of pension funds that a lot of old individuals have invested their lifelong savings in. And guess what those pension funds invest in? They invest in real estate markets, especially commercial real estate. And commercial real estate for so long was looked at as something that's very safe, and it's a safe investment. It's not going to go bust on you. But now this is the opposite. Now this is becoming such a risky asset to invest in that those people that have invested in pension funds, they're in a more risky game. Now there's a chance of losing money, and a lot of them to an extent have lost money already because properties are losing value. For public pensions already underfunded by an estimated $1 trillion, that's bad news. But guys, I'll be honest with you, the commercial real estate problem that we're seeing, this crisis altogether in 2024, it's a lot more tangled up. It's not so easy. There isn't a clear solution to this, or else we would have found it and it would have been over. We wouldn't been talking about this. So again, it's affecting local governments. It's affecting retirement savings plan. It's affecting you right at home. But guys, this is the year of 2024. We should expect challenging times, especially because 2023, we're all saying that this would be the time that we'd be in a recession. We're not. I think we're still going to be in a recession, but that's another topic for another video for another day. But for now, if you guys enjoyed this video, please like, subscribe. I'm trying to reach to 1,000 subscribers. I know I'm going to do it. Whether or not I have to buy subscribers, I'm going to buy them. But yeah, no, I'm just joking. But guys, like, subscribe, and I'll see you guys in the next video.